So hello everyone, welcome back to MTG Live Trades 2025 Mentorship. This is lecture number 6. So in the two previous episodes I've been talking about the opening range, the first presented fair value gap, the initial high and initial low. And in the previous lecture, in lecture 5, it was a different model. It was the 11:50 to 12:10 p.m. macro, which I've also talked about in lecture 1 and lecture 2. So this lecture is, again, it's gonna be about the opening range and the first presented fair value gap. This is a different model. And today I'm not gonna do the top-down analysis because you guys know it's the same chart. I've done it in the 5 previous lectures, the 5 previous episodes, so you guys know what is going on the higher time frame, and you know what I'm thinking about the higher time frame bias. So this way, let's get right into the chart. So here we have the first presented fair value gap, okay, and here is the initial low, the first swing low after 9:30 a.m. Okay, this is the initial low. And right here we have the initial high that has been taken out. Okay, so at this point we have to wait and see how price is gonna represent itself, what is price is gonna do. So on the weekly chart here, oh my god, let me just take this one off for a second. The paper trading accounts, it's annoying, can't see anything. So here, this is the weekly chart. You can see price has been trading up, it's trading higher, it's above the new week opening gap, the previous new week opening gap, and this is this week's new week opening gap. So we have a huge volume imbalance here, a gap below the market, below the price. So price has been trading up to this weekly fair value gap. Okay, and on the daily chart, we can see price has been trading up to this bullish fair value gap. These two up close candles, this consecutive up close candles. Here's the buy side liquidity, which I've talked about in the previous lecture. And at this point we have also the new week opening gap here in the daily. And on the hourly chart, you can see that price has been trading low right now, and it's probably aiming for these relative equal lows here, the sell side liquidity. On the 15-minute chart, we can also see that price has been trading lower since yesterday during Asian session. And then on the 5-minute chart, we can see here this is the midnight open. Price has been trading above it, below it, and then during London it traded above it again, created the London high, and then traded lower. Here we have the London low, which has been taken out, so let's mark this out. So London low has been taken out, right? London low, and then we have here the London high, which is still in place. London high. Good. So now we have also the 8:30 opening, which price has been trading above it and then below it, and then here at the opening range it traded above it, and eventually it started to trade lower. And we go lower to the 1-minute chart. On the 1-minute chart we can see here again London high is still in place. We have buy sell liquidity. Price has been trading lower. It took out the initial low. Okay, and this seems like a displacement. It looks like a displacement with a breaker, but I'm not gonna rush in and hurry and just try to get into a trade. I'm waiting here patiently to see what price is gonna give me, how price is gonna represent itself. And if I miss this entry, it's completely fine with me. I don't care, because the account is up 2.7% so far, and I don't really care if today goes without me, because I don't see a clear bias or a clear trade here from me personally. As I said before, here there's the relative equal lows are taken out. I think it was on the hourly chart, right? Yes, here on the hourly chart, I've said it just a minute ago, the relative equal lows are taken out now, so it's trading lower probably to this fair value to this bullish order block, this two down consecutive up close down close candles. But at this point I'm just waiting patiently to see how price reacts and how price presents itself. And it is very important to mention here that we had a opening range gap higher from yesterday, right here, from here, opening range gap lower, excuse me. So here, this is the opening range gap. This is the close. This is the high of the opening range gap, and this right here, this 1 minute candle, this is the low. The opening of this 1 minute candle is the low of the opening range gap. Let me actually mark this out. I think it's kind of confusing for someone who's new here and doesn't have a clue what I'm talking about. So here it is. Here we have it. I didn't want to do that. Okay, so here we go. 4:14 p.m. right there, the close of this candle. We mark this out, and then we extend this to the right. It goes to the right. Boom, boom. Let me zoom in. We zoom in, we zoom in. So right now we use the low because the high is what we use for the candle, right? So we go here, we go lower, and mark the opening of this 1 minute candle at 9:30 a.m. out. So here you can see, guys, that I've been actually talking about this, that this model is a 70% win rate. We can see that price has traded to the consequent encouragement of this one of the opening range gap. So right here at this point, price might just start to trade lower. Right here we can see price traded to the 50% of the consequent to the 50% of the opening range gap. Right there, this white line here. And yeah, it started to trade lower. So at this point, I think that price wants to trade lower and aim for the sell side, and I will be aiming for the London lows from yesterday, from the previous day. Or what I'm gonna be aiming for is this sell side liquidity here from the from the New York AM session from yesterday, the previous session. So at this point I'm waiting. I want to see price trade. This is its clear displacement. I want to see price trade higher and use the first presented fair value gap as an inversion fair value gap, or it might just use this fair value gap here and start to trade lower. Because I understand, discount and premium. So this way I gotta wait and I cannot rush in. So right here, now we have to wait if price gives us a swing low, a short-term low. Then we can mark this out, and yeah, we can see the 50% level of this range. So hypothetically, if we use this candle as the 50% level as a swing low, so price must just trade higher to the 50% level of this bearish fair value gap for me to enter the market and go short, because I understand and we know what premium, what expensive, and what discount and cheap means. So it seems like price is strongly bearish because we are below the midnight open, and we are also below the 8:30 opening, which price has just traded above it and then eventually started to trade lower. And this could have been a great trade, but I wasn't sure about the bias, so I didn't took it. This way I avoid a losing trade. And this is another important lesson about trading. If you're not sure about the bias, and if you're not sure about if there is an entry or if there's not an entry, you just don't do anything and you just watch and absorb price, and you should just learn from the price action. The thing about trading is many people think, yeah, you can drive Lambos around, you can be a millionaire in 2 months, in 1 year, and whatever. Yeah, it might be the case for few people, but it's not realistic, If you want to be a good trader realistically, you have to be patient, you have to, you have to have risk management, and the most important thing is you need capital. If you only have, I don't know, $1,000 or $2,000, you can't really, make a lot of money in 1 year or in 1 month. Because if you make, let's say this month I made 25% of the account, which is a lot. This is really, you've got to be a great trader to make this amount of return. But hypothetically, let's assume I did 25% this month, okay? 25% of profit. If my account is $1,000 account, this would be just $250. I know it might be a lot for a lot of you guys, but this is not a this is not a big money. This is not a lot of money. This is really nothing. So, but if you did the same amount of return with a 100K account, this would have been $25,000. And this is the difference, You don't need a different model. You just need a bigger capital. You just need more money to trade with. And by that, I don't mean you have to go to the bank and sell your house, or I don't know, do whatever you're thinking about doing. I mean, the money for trading, the money that you want to trade with, you have to forget it completely. You have to have this mindset. The money that I'm willing to trade with is already lost. And if this is the mindset that you're going in for trading, then you wouldn't, you would not have a really hard time trading and losing trades. Even though losing trades doesn't mean that you're not profitable, it just means that your model on that day, on this week, on this month is not presenting itself. This is all it means. One of my very guy, I don't want to say his name, is a very good friend of mine. I've talked with him yesterday. No, it was two days ago. And we have talked. And he had a losing streak. He told me that the 2 previous weeks they were like really, it was not that profitable for him. He had a lot of losing trades, and he was feeling kind of sad, and I don't know, he had just a hard time to deal with the losing streak. And I've actually told him that he's still in profit, even though he had for 2 weeks he had a losing streak for 2 weeks. He's still profitable, he's still up on his account, but he was kind of blaming himself, and he was like, oh man, I'm fucking shit at trading, I should quit. And I was like, brother, you are trading since 3 years, and I can swear that you're better than 80% of all traders out there, that they think they're really cool and they're really good at trading. They might be profitable on the internet, but they don't do, they're not actually profitable. So for someone like me that comes out here and shows his hands, he posts about his losing trades, he posts about about his winning trades, and he does it live during the market is right here, it is live, and it does it in front of people. It takes really courage, it takes really courage, and it takes a lot of balls. So it's not an easy thing to do. You're playing with your ego, but I'm doing this because I know I might just help few people, and I might help people to learn how to deal with losing trades, and that it is a completely it's not realistic for you to never ever have a losing trade again. It's just part of the game, and everyone must learn how to deal with losing trades. Okay, so far so good. Now price has traded lower, and it takes out the lows here, the London lows from yesterday, which I've talked about like about 5 minutes ago. I'll mark this out, and price seems like to be really bearish, but I'm not gonna take any trades here. It might be an institutional order for intraday right here, this low, but I'm still not gonna take it. Because I don't really feel sure about the price action right now. So this way I'm just gonna wait and absorb price action and see what price is gonna really do. Okay, the paper trading account is connected, good. And I say it again in this lecture, there is no real money involved in the trades that I post on this YouTube channel. I do actually trade with real money. I'm not gonna say here how much, but I have an account which is not really small. It's a pretty solid account. And I'm trading with live account with real money. But as I said in the first episode of the 2025 mentorship, I'm not qualified to do that. The government will not allow me to post about trades with real money. So this way I can, protect myself. First of all, protect myself, and then eventually protect you guys, because I know if I do it here with real money, there are gonna be people who think like, oh my god, if he's doing it with real money, then he's not gonna take a losing trade and he's gonna be perfect, and because if he has a losing trade, he will lose money, so I'm sure he doesn't want to lose his money, and this way let me just take the trade that he's taking. Yeah, but even though it is real money, I'm still gonna lose with that money, because this is just part of trading, and I have a good risk management. If I'm having a losing trade, it's only 0.5% of my live account, or it's only 1%. Maximum 1.5% of my account. But I'm sure there are gonna be people who think like, okay, he's doing it with real money, so let me do it with real money and risk 20% of the account with that trade, and over leverage. This is why I'm not gonna do it with real money. But you can see, guys, I'm doing it right here in front of you all with paper trading account, with demo account, and it is pretty much the same with real money, except with a live account with real money, you have the emotions are very strongly involved, and you're gonna feel happy if you're having a winning trade, if you're gonna feel really sad if you're having a losing trade. And this is the only difference between a demo account and a live account. But the technical analysis is gonna be the same. It is always the same. It doesn't matter a live account, a demo account. It is 100% always the same. And yeah, so this way, if you're doubting my technical analysis here, go fuck yourself. Yeah. So at this point, I'm waiting for price to give me a displacement to the upside, or at least a trade higher to the 50% level. In this area. You know what? Let me actually mark this out. Let me balloon this right there. In this area, from here to this level, there is no way that I am gonna take a short trade. I'm sure there are people out there who are telling right now, who are saying, oh my god, this guy's stupid, he doesn't know how to trade. This is an institutional order for intraday. This is another re-entry, blah blah blah. But from my personal experience, I've learned that sticking to my model, which tells me about discount and premium, I will have more losing trades if I take a a short entry inside of this area instead of just waiting for price to go above the 50% level and then eventually look for a PD array here in the premium and take a short trade of it. So this is what my model is telling me, and there is no way that I'm gonna take a short trade here inside of this area. Yeah, sure, if price trades above it and trades, maybe to this breaker block right here, this 3 consecutive down close candles, which are a bearish or bearish breaker block, or if price just trades, above this short-term high, the swing high, and maybe consolidate around it a little bit and then trade higher and then use it as an turtle soup setup, or if price goes to the first percent fair value gap and use it as an inversion, I may take a short trade. But inside of this area, as I said, there's no way that I'm gonna take a short trade. And vice versa, here inside of that area, this area right here, there is no way for me that I am gonna, well, no, this is pretty much wrong. So because I will use a new price leg, so this way I can actually buy inside of this area if price trades higher and then eventually use it as a discount rate. So here, above here, inside of this area, if price goes here to this blue shaded area, I am gonna sell, okay? Or I could sell because this is a premium. But inside of this area, below here, the red shaded area, there is no way for me that I'm gonna, sell inside of this area because this is a discount array, or a discount, not a discount array, excuse me for my language. This is a discount level, let's put it that way. So this way, guys, this is the level, the consequent encouragement, 20,192.9. This is the consequent encouragement, the 50% level, so I'll be waiting for price to go above this level, and then eventually I can take a short entry. Or if price gives me here a displacement to the upside with a clear fair value gap, with a clear breaker, then I might eventually, start buying here, because as I said before, we are here inside of a discount array, so I can buy here a discount area. So if price gives me a displacement with a clear breaker, clear market structure shift, and a fair value gap, then I'm gonna buy here and then eventually aim for the first percent fair value gap, or just aim for this short-term high here, or the low here, the initial low. And this is the interesting part of trading. If a PD array fails, you shouldn't just put it away and say, okay, now it's broken, now the PD array didn't deliver, so let's just forget about it and find a new one and search for a new PD array. This is the wrong mindset. Whenever a PD array fails, we can use it as an inversion. For example, let me give an example here. So when let's assume price trades higher and closes above the breaker block here, the bearish breaker block, and if price closes above it and then it trades lower and does a retracement, or some sort of retracement on just a little bit lower for smart money to accumulate more position, I will use this breaker block right here, this bearish breaker block, as an inversion, and I will use it as a bullish inversion, as a bullish breaker block. So I will use it as an inversion. And this is the interesting part about about being a smart money trader. There's always an excuse for your excuse, or there's always an excuse for what the market is doing. All right. So London low, you can see, has been taken out. London high is still in place. No trade above it, we can see, so we have relative equal highs here. But only because we have here the London high, it doesn't mean that price will trade above it today. It might do that tomorrow, or it might do that in 2 weeks or in 3 weeks, but we know that price is eventually gonna trade above the London high, because these are relative equal highs. You have a high here, another swing high here, another high here, and then starts to trade lower. So let me also introduce you guys a little bit to the market structure. So we can see here, this is a intermediate term high. Why? Well, because we have a short-term high on the left of it, and another swing high or another short-term high on the left, on the right of it. And then price trades lower, creates a intermediate term low, and we have another intermediate term. This is actually a long-term high. Okay, why? Well, because we have a intermediate term high on the left of it and an intermediate term high on the right of it. So if price is bearish, in this case it shouldn't trade above the intermediate term high, because it has also displacement and feel the displacement traded high. And this is also, it could be used as an intermediate term high, because why? We have here displacement, so feel the displacement, start to trade lower with displacement, and then eventually it traded lower. So at this point, if price is genuinely bearish, there in no case it should trade above this intermediate term high here. Why? Because as I said again, it feels a displacement, an imbalance. It has also on itself an imbalance to the downside, and this way price should just trade to the bearish fair value gap here and then start to trade lower. So this fair value gap right here. And by the way, we are on the 5-minute chart. You can see it here. And this is live market open. Okay, no replay or whatever. So it seems like that price is pretty bearish today, but yeah, I couldn't take an entry, unfortunately, so far, because, well, yeah, I missed the entry, or I realized the market structure pretty late, so this way I couldn't enter it. But it's fine with me. It's okay. There's no problem with that. The most important thing here is that I avoided a losing trade. I avoided, putting the account down. And yeah, it seems like price wants to trade lower. So it seems like he wants to go inside of this here, this fair value gap, this bullish fair value gap, this busy. And yeah, it aims also for the lows here, relative equal lows. But this is a huge liquidity void here. This is a very big liquidity void. That price might eventually, I'm not saying that it's gonna do that, I'm just assuming that it might trade higher and yeah, fill this liquidity void and fill it and consolidate around that level. Now let me take all of this out. This is too much distraction right now. And again, we can see here, this is the opening range, 930. We have here the opening range gap, a lower opening range gap. What is price doing right here? What is it doing? It's trading to the consequent encouragement, to the 50% level of it. And I've talked about this on lecture 3. On lecture 3, where I've introduced to you guys the first presented fair value gap and the opening range gap theory. So here, the opening range gap, you can see that price traded to the consequent encouragement, to the 50% level of it, and then started to trade lower. So this is a unique model on itself, which has a 70% win rate. So I know it's not a big deal, it's not a big trade, but it would have looked something like this if I would take this trade. Okay, so here is the first percent fair value gap, displacement to the upside, and then right here would be the entry. Stop loss would have been here, and then I would aim for the consequent encouragement, which is a 1-to-1 trade, but this is not a really good trade. I would never take this as a trade. So it would have been 0.7% of the account, or you could risk more and do 1% of the account, so 1% trade here. but this is not a good trade. There's no case I would take a trade like this. This is too much risk and too little return for that risk. I don't like this. So yeah, but this is what the model is telling us right here at this point, because yeah, what the model is telling us, we need a displacement with a fair value gap and then a trade higher or lower to the opening range gap, consequent encouragement 50% level. Let me also take this one out. It's taken off. Okay, good. And right here, this is also part of this model, 8:30 opening. You can see here price opened at 8:30. This is the opening. Okay. Opala. 8:30 opening. Price rated below it, above it, below it, and then at the opening range, it started to. It was, at the opening range, price was still below the 8:30 opening. So at this point, price started to trade above the 8:30 opening, which was also a level of the 50% of the opening range gap, and eventually it used it as a premium PD array, and then it started to break and decline and trade lower. Okay. At this point where price closed below the first percent fair value gap, if it gave me a trade higher again to the first percent fair value gap, or at least to this up close candle, or two up close candles, well, yeah, here, two up close candles, I would have used this order block or the wick, at least the wick of it. Now my stop loss would have been above here, the 50% of the wick, and I would have used this wick because this is the bigger one. So my stop loss would have been here, above the 50% level of it. And yeah, I would have used the order block or the first percent fair value gap as an inversion fair value gap, and I would have aimed for these lows here, which I've talked about on the hourly chart in the beginning of this video. So this would be my aim, which would be 20,230 to, okay, it would have been something about 30 handles or 30 points, which is a solid trade. It's not bad. My stop loss would have been here, so a stop loss of how much? Let's say 15 ticks or 15 handles, not ticks, handles, 15 handles. So it would have been a 1-2 trade, 1-2 trade. Yeah. Okay, at this point, let's see what price is doing. And in a market structure like this, where price is showing us that it's pretty, it's strongly bearish, we don't want to see a trade above swing highs and short-term highs, and we also don't want to see a trade above up close candles. And there shouldn't be many up close candles, because up close candles should only form for price to later on go back to them and accumulate more position for the smart money and then start trade lower. And if it trades above the up close candles, this is not a good sign, and it shows us that the price is not really that bearish anymore. So here at this point, price is still bearish because it's making lower lows and it's making lower lower highs. This is kind of a, we could also say that this is a small consolidation here. It's consolidation, yeah. From this high, I'm using the body in this case here, the high to this low. It's consolidating around this area. It's very rangy. It's a balanced price range. There is nothing for price to look for in this area. It is very balanced. There is no imbalance in this case, in this price leg. So prices start to trade lower. It's trading to the new week opening gap. The previous week's new week opening gap, not this week, excuse me. And this week's new week opening gap is right here. So it might just start to trade lower. And it is important to mention that today is Wednesday, so I will also talk about each day of the week and the importance of each day of the week. So Monday and Tuesday are most of the time the manipulation phase for the weekly candle, and Wednesday and Thursday are gonna be the distribution, the actual move, the strong move to the downside, and Friday is gonna be TGIF, meaning Friday is gonna be a counter trend, a small trade. In this case, if your bearish and price is trading lower, Friday is gonna be trading higher a little bit, and then create a wick on the weekly chart, and then close a little bit higher. So it would look something like this. Let me just show you guys here. So let's assume this is the weekly chart, okay? In this case, we are bearish. So here we can see this is the opening. Right here we have the opening. So this is the opening. And in this case, Monday and Tuesday price started to, so this is Monday, price started to trade higher, price was bullish, and on Tuesday it also traded higher. Okay, this is the manipulation. So this is the opening, this is the manipulation. All right, and then price started to trade lower. Okay, so this is now a wick on the weekly chart. Price started to trade lower. So on Wednesday and Thursday, let me actually do it this way. This is pretty confusing. So here, so on Wednesday here, on Wednesday and on Thursday, this is Wednesday, price starts to trade lower, and on Wednesday price, and on Thursday price will start to trade lower again. So this would be the distribution, the actual move of this week. So because I think that this week is pretty bearish, so price will eventually trade below the new week, this new week opening gap, and then even trade a little bit lower and maybe take this low out. And then on Friday price will do something like this. Price will from here start to trade a little bit higher again, okay, and this way create a wick here, start trade higher and create a wick, and then close around this area. Let's say this is too much. Let's say it closes around this area because it's gonna be a 25% retracement on TGIF. So it will close around this area. So on a candle on the weekly chart, it will look something like this. So this is the opening. All right. Right here, opening, and then a wick higher. And we don't actually need this, so let's do it this way. So this is the wick right there. This is the right there. This is the opening. This on Monday and Tuesday price trades higher, does the manipulation, and then on Wednesday and Thursday price trades lower, so it comes here. And then on Friday, what is price doing? On Friday, price will trade higher, maybe 25%, the TGIF, and create a wick. So this is Friday, this wick creates a wick and then closes around this level. So this is the power of 3, what I've just explained here. This is the power tree. This is the manipulation, accumulation, and distribution. Very important for you guys to understand. So this is the theory of the for each day of the week, and the importance of the power of 3. And what I've just explained here to you guys, this is very, this is important. This is important lesson. You will not hear this on YouTube, even though there are many ICT traders out there. Even though, even ICT himself, he explains this on his in his lectures. He explains this kind of. He makes it so complicated. It took me a lot of time to understand this, because he explains it so hard, and he does it in about 5 lectures or something like that, and it's kind of confusing even from himself. So what I've done here for you guys, this is precious, this is very, yeah, you should just be thankful for what I've explained here, because you will not hear this anywhere else on YouTube. Sure, you can go to ICT and watch from his lectures, but it takes more time, and it takes more of of your hard work to understand it. But yeah, what I've done here was just important, and this is what I'm saying. Okay, cool. Great. Now again, another price like here. Displacement lower. Seems like price wants to reach for the low here, right here. Seems like price wants to reach for the low right here. Oh man, come on. For this low, which is the opening, which is the opening range from Monday, so the 9:30 a.m. from Monday, and eventually it is aiming for this week's new week opening gap, this volume imbalance, this huge gap. So here is it, new week opening gap. So right now, a lot of people has just forgot about the new week opening gap below here. They have forgot it completely, because so on Monday we were trading higher, so retail thinks, okay, we are 100% bullish. On Tuesday, price traded higher, so retail is thinking, man, come on, I'm the fucking genius, I know price is bullish. So yeah, and smart money on Wednesday starts to accumulate their positions, and they distribute it, they send price lower, and they fuck everyone who think price is bullish, and they send price to the new week opening gap right here. Man, this game is so cruel. It took me a lot of time. The first year of trading, the first year of my experience in trading, man, I had a lot of sleepless nights. I've cried a lot. I've lost a lot of money. It was not easy, man. It was really not easy, but it's a cruel game, I genuinely feel sad when people are new to trading and they're coming into trading with this positive mindset where they think, oh, everything is great, and in 2 months I'm gonna be profitable, because I know what they are about to go through, because I've been through that shit, and I know how hard it is, and I know how much it hurts. So I really genuinely don't wish that for anyone else. I don't want anyone else to go through the shit that I've been through. So yeah, this is why I personally don't recommend trading to anyone. Even though it's if you stick to it, if you do the hard work and you're disciplined, you will one day get it. I don't know how long it's gonna take for you, but for me it took around 3 years to understand it completely and become a little bit profitable. But yeah, it's a cruel and it's a harsh world. So at this point, now we know each day of the week. I actually, I wanted to do a specific lesson, a specific lecture, maybe the next lecture. I thought maybe lecture 7 or something like that. I wanted to do a lecture only about the days of the week, and what kind of characteristics they have. I want to do a lecture only about the characteristics of for the day of the week. But I'm just explaining to you guys. I explained it to you guys here in this lecture, so I don't think that this would be necessary. And if you need a a specific lecture, a specific episode only about the days of the week, and also the importance of the sessions in each day, and the characteristics on, for example, the characteristics for the London session and New York session on Monday, and London session, New York session on Tuesday, and so on. You can, guys, write me an email, or you can write me a comment, and under this video, in this lecture, like lecture 6. And if I feel like many people want to know this, and many people want to understand it, and you guys want a specific lecture about the characteristics for the days of the week, then I will consider it, and I might just do a specific lecture about it. But I think so far so good. I genuinely don't think you should know you should know every detail on all the specific things and details about the characteristics of the week, days of the week. I think if you understand what I've just explained in this lecture, with the shaded area right here, what I've done, if you have understand this, and if you feel like, okay, I know what this guy is talking about, you should be good. You should be good about the weekly candle and the power 3 for it. So the manipulation, accumulation, and distribution for the weekly candle. Then if you understand this, I think you can pretty much find a good high time frame bias. So at this point, here is the London close. Okay, it's trading to this fair value gap. If I get a close, let me actually mark this out. So I'm gonna use this swing high and not this swing high, because in my I think like this is where this placement, that the down move has started. So we are also above it, above the 50% of it. So at this point, if I get a close below this small here, below this, a close below this BISI, this bullish fair value gap, I might take a short. Okay, so right there, but it seems like it wants to trade higher. So, and I'm not going to use this as a bearish fair value gap. I want to see a clear close below a fair value gap, below a bullish fair value gap, below this BISI. And if I get this, a close below this BISI, then I will use it as an inversion and trade a mid lower and aim for maybe this sell side, or even I could aim for the sell side right here, the low from the opening range gap, from the opening range of Monday. I know right now it seems like a lot for you. It seems like this is too much for me to take, and this is too hard. I'm never gonna get it. I will never be a trader. I know it seems so complicated to you right now, but I promise you, I swear, if you stick to it, and if you're disciplined, and if you do the hard work every single day for 2 years or for 3 years, you will thank yourself. You will be thankful that you've done the work, and you will feel like you're the man. Even if you don't become profitable, you still think like, I'm the fucking man, because I have the discipline, I've trusted myself, I've trusted my guts, and I know that I'm able to do the hard work. So yeah. Alright, so here is the SIBI. I know it seems like it wants to react to the SIBI, but it isn't actually reacting to it. It's just trapping it's a trap for the retail trader. This looks like an order block, but I don't think that this is a valid order block, because price is, well, price is bearish. And if you think under market condition like this, you think price is bullish, then you're just stupid. I'm sorry. You didn't understand a fucking word of what I've said in the 5 or 6 previous episodes. So go do something else. Don't watch my videos anymore. Okay? I'm just kidding. You will get it. Don't worry. Daddy's here for you. Alright. Now it seems like price wants to trade lower, so I want to see a displacement to the downside, a decline. So close but below this swing low, and also below this BISI, this bullish fair value gap. And if I get this, I will use it as an inversion, as I said before, and then eventually aim for the sell side here from Monday opening range. And I might even take 10 contracts off here, but let's see what price is doing. Let's not assume more than we already did. So don't mix the London close trade, the silver bullet model. You know, don't mix that with the 11:50 to 12:10 p.m. macro, because the 11:50 to 12:10, the launch macro, the launch hour macro, this is a counter trend. Okay, it's a counter trend, and if price is bearish, this is gonna be a move to the upside. If it's a if price is bullish, has been trading up, then in this macro it's gonna be a trade lower, a small retracement, a counter trend. This is not the same thing as, you know, the silver bullet, the London close here. These are two completely different things. And I'm telling you this because in episode, I think it was episode 5. Yeah, in episode 5, in the previous episode, and in lecture 1 and lecture 2, I've talked about the counter trend and feeling safe under a market condition like this to go, you know, to go long. But I mean this only on the launch hour macro, not in the London close. This is a completely different thing. This is a different scenario. So if you go long in a market condition like this, then yeah, I'm sorry, because you're gonna lose and you're gonna blow the account. You lose, you lose. You snooze, you lose. Okay, it seems like price is slow right now. Alright, guys. Well, it seems like I think it's gonna be it for today. I don't see any trades here, so I think it would be it for today. No. Well, yeah, no trades for today. I know it's called the MTG Live Trades 2025, but only because it's called it's called live trades. It doesn't mean that I'm gonna trade every single day or in every episode or in every in all the in every session or every episode. Um, it's part of trading. Sometimes you can't just trade because your model is not there and price is not giving you what you want to see. So this way you don't trade and you don't lose money. So you save yourself from headache. And another important thing here is not taking any trade and being in break even is better than losing trade. So just because you have the feeling like you need a trade today, it doesn't mean that you should, because if price is not presenting itself and if price is not giving you enough evidence of that it really wants to go where you think it's going, you just avoid it and you just don't do anything. And also, if you feel like you're in chaos, you're lost in the price action, you don't know what to do, then just don't do anything. Man, I know it sounds kind of too easy to be true, but if you think like, okay, I'm lost, I don't know what price is doing, I don't know what the bias is, or I don't know what the higher time frame bias is, then don't do anything. Just don't do anything. Step to the line, and then wait for price to see what it's gonna do. So here, this looks great for me because I'm gonna use this fair value gap as a inversion, and this right here, what I've done here, it shows to you guys how important it is to be patient in trading and not to not hurry just to get into a trade. So if I get it close below this fair value gap, so it seems like it wants to trade above it, I'm not gonna use it here. I'm not gonna go short in this case. But if it closes below it, I'm gonna use it immediately as an inversion and start to aim for this low here. So let's see if we get a close below this below this bullish fair value gap, and then if we get that, then I'm gonna use it as an inversion. So now I want to see a trade to it again, as trade higher to this fair value gap, and if it does that, then I'm gonna sell immediately. Nothing there so far. No trade to the fair value gap. Nothing there. I'm not gonna sell. You guys can see how patient I am. So right there, boom, I'm selling 35 lots. My stop loss is gonna be right above the swing high here, this swing high, and I will aim for, as I said, the low right there, the sell side liquidity from the opening range of from Monday. So this is the opening range low, or the New York low from New York AM session low from Monday. Okay, so you guys were very fortunate that price gave me the model, because I was actually just about to turn off the computer and go to my training. But you guys are lucky, you lucky bastards. You get the live trade here. So I'm doing it in front of you guys. I'm doing it live. There is no tricks here. I swear to God, this is what I do with my live account, with my with live money. If I'm doing the exact same thing with my live account. So there is nothing hidden. I'm not hiding anything here. There is no secret to it. I'm just showing you what I would do if I would just take the exact same trade with my live account with real money. So here is also again the proof that it is it's the live market. It's the market open. You can see This is not a market replay or whatever you want to call it. This is the proof that my model works. So in this case, I'm pretty sure that it's gonna be a winning trade. And also my trade to this, let me actually take 10 contracts off here just to be safe. And this is another important lesson that I'm gonna talk about in the next lecture. Taking partials. Taking partials is very important. It's underrated. If you don't take partials, you're stupid. Well, let me take this back. This sounds kind of it sounds kind of hard because there are still big profitable traders that they actually don't take partial and they're still profitable. But in my opinion, if you don't take partials, then you're doing something wrong. So I'm taking actually 15 contracts off here, or I could even take 20 off. Let me actually take 20 contracts, 20 lots off here. So this is more than half of the position. I'm gonna take this off right here inside this bullish fair value gap, inside this BISI, but because it might just react to it and start to trade higher. But we don't know. Let's see. And I'm not gonna move my stop loss. I'm gonna let it there. I could actually move the stop loss to the high here. Why? Because there is a small SIBI, a small bearish fair value gap right there. I don't know if you guys can see it, but this is the high of this fair value gap. And if it trades above this high, then it's fine with me. Then I will take this losing trade and just go off, and that would be it for today. So it seems like it wants to go higher. Now let's see. Okay, well, it's a losing trade, guys. Very unfortunate, but it is only 0.4% of the account. I'm fine with that. I don't feel bad or I don't feel sad or anything here. I'm completely fine about it. Even though it's a losing trade, it's okay. It's just part of the game. So I think that would be it. I hope you guys found this lesson, this lecture insightful. I hope you guys learned a lot here. And if you guys have any questions or you don't understand anything that I've explained here, you feel free to write me an email or write in the comments. So these two trades are from yesterday. You can see here. Ignore all of these trades here. This is the beginning of the account. Okay, these are all distractions. This is just stupid trades that I've taken token, and I was just trying to play around. So here was the start. Okay, and you can see, guys, that we are 2% up on the account right now, 2 and 1%, and this was a 0.4% loss. And yeah, that would be it for today. Till talk to you next time. Be safe.